Systemic risk in China is obviously a key concern and a reason that they decided to intervene in the equity markets. There was a five-fold run-up in margin credit that helped to fuel the boom in stocks. And I think that there was legitimate concern that too precipitous a drop could lead to losses on those loans, margin calls, that could erupt into a more systemic crisis. So that the initial response had been to try to stem the declines so as to take that risk off the table. I think that the scale of overvaluation was such that Chinese authorities begrudgingly came to the conclusion that these resources could be better spent elsewhere, creating systemic safeguards. Well, I think that the announced devaluation of the yuan is part of a reorientation of monetary policy in China away from defending an overvalued exchange rate towards domestic reflation. So I expect that the Chinese authorities, the People's Bank of China, will in the near future cut required reserve ratios, reduce policy lending rates, perhaps liberalize interest rates further so as to reduce real interest rates, ease domestic financial conditions, and help to address the deflation in producer prices in China, help to put a floor under industrial input prices. So I think that is the orientation of monetary policy going forward. When we were looking at the market totaling EBITDA for all public companies as of June 30th, it looked as though the market was still 25 to 30% overvalued. So, obviously the losses last week and today have cut into that significantly. There's significant risk of overshooting to the downside. So if fair value is another 10 to 15% away, perhaps they'll go through that. But you have a natural situation in markets where risk premia are rising. When risk premia rise, prices have to continue to adjust downward. Eventually, there will be deep pocket investors, longer-term investors, who see very attractive opportunities. And when that occurs, you're going to find a bottom.